What's up, guys? Welcome to the video. So today I'm going to do a live take profit trader withdrawal, and I'm also going to have a discussion on practical tips for tackling the intraday trailing drawdown. And I also want to lead into the setup that got me this payout and also conclude with my thoughts on the ICT 2024 mentorship model and how I use the concepts to help me trade. And I don't trade exactly how ICT created the model, but I will get into that after the first discussion. So now that the payout is processed, I already connected to Played before the video started to make it smoother. But as for practical tips to handle the intraday trailing drawdown, I would say treat the pro account buffer building phase like the test account phase. Go in with the mindset that you have at least 5 days to reach the $1,500 buffer. And this is applying to the 25K accounts. Because I trade 25K accounts, and the trader that asked about this question, or a couple of traders asked about this question, and they are also trading 25K accounts. So go in with the mindset that you have at least 5 days to reach the $1,500 buffer, just like the $1,500 profit target in the test accounts. But the test accounts are a lot easier. But anyways, if you give yourself at least 5 days, you won't feel pressured to hit a day one payout. And you know, the day one payout model can actually be a trap. It tempts you to rush, which often leads to overtrading and overleveraging, which preys on human psychological weaknesses. They know what they're doing. So limiting yourself to one mini contract max until the buffer is built helps a lot. Even a single loss can shake your psychology while the intraday trailing drawdown is in play. So focus on base hits, not big home runs. And base hits are different for everyone, but we'll get into that later. Base hits for me are like 30 ticks. That's usually the base hit for me in general, because chasing large targets increases the chance of a retracement, and trailing stops may considerably reduce the intraday trailing drawdown buffer, especially when emotions are involved in managing stops. So once you have solid profits for the day, protect them by walking away. Having profits makes it easier to become emotionally attached to the next trade, leading to irrational decisions. And similarly, after a loss, step back and clear your mind before trading again, so your next decision is more rational. And only take your highest probability setups, or your highest probability setup, the one you rely on the most. Stick to one strategy so you can collect consistent data over set samples of trades, because the progress happens over a long period of time. So focus on the setup that the version of you who consistently gets paid would take, and that's your edge. This setup is going to be your bread and butter setup. And just don't get too discouraged. I know this is really brutal. This is a really brutal process, but discipline breaks will happen. Always remember that. And bad habits will always creep up. But journaling and identifying patterns that lead to brutal sessions can help you take actionable steps to mitigate the risk of repeating them. And that's the power of journaling versus if you didn't at all. Journaling is key, and not only will it help you identify patterns that lead to destructive habits, but it's also a way to collect data and refine your edge. And the way I actually found out that I like trading reversals is because my data showed that it worked for me, so I stuck with that. And I like screenshotting my past trades, win or lose, and look at them from an outside perspective, like a bird's eye view, asking myself, was this the execution or executions of a sound mind, or was I completely out of line? It's important to journal both good and the bad. Journaling the good is easy, but journaling the bad is not. You can't avoid the bad sessions and what happened there if you want to break free from bad habits more efficiently. And they'll always come back in your trading. At least from my experiences, bad habits always come back and it doesn't get easier, but you can become more aware of them. And being aware of them doesn't mean you'll stop yourself from doing anything stupid. And bad things can happen at any moment. But anyways, let's pull up the charts. I want to discuss my thoughts on the ICT 2024 mentorship model. But before we begin, I want to mention that I only trade gold and it's the only market I really look at the moment. This price action suits me the best. And although I trade around the ideas and the concepts from the mentorship and the model, ICT says he doesn't trade gold. He doesn't day trade gold. He only invests in it long term. And the model and mentorship was based on trading NQ. So over the better part of this year, I've been studying and reading the tape to see how it applies to gold. And so far, I still like using the ideas and concepts around the model in my trading. And before I begin, I want to mention that another trader inspired me to have this discussion, and questions about other topics also led into it. Reversal trading is what I rely on. And I do take some continuations, but that's a different discussion. And relying on your highest probability setup is one of the tips I gave for tackling the intraday trailing drawdown. And based on my data, reversal trading is my highest probability setup. It's my bread and butter setup, like I mentioned before. And whenever I say base hits will be different for everyone. Some people are starting with 10 ticks, other people do 20 ticks, but for me, I like 3 handles. I typically look for setups that can give me 3 handles. Even 25 ticks is good, but I'll take whatever I can get. And I try to look for setups based on this base hit 30 tick model. More is always good, but 30 ticks is great. It's good enough. But always take what you can get. And maybe you don't like trading reversals, but that doesn't mean the lessons on mindset and psychology I discuss won't help you. Anyways, with this said, let's get started. And this will likely be one of the many discussions since your edge can't be developed in just one. It's something built in silence and in the darkness that comes with this journey when no one else is clapping or applauding. And while discovering your edge, you'll likely reach your breaking point, not once, but many times. And you'll want to quit. And that's up to you. And I'm a firm believer that trading is not for everyone. But if you truly put in the work and take actionable steps to improve, I believe anyone can. It's one of the hardest things you can do in the world, and not many people are willing to go through the necessary pain to see progress. But if that's you, then I'm here with you because, like you, I'm a developing trader in the trenches, and I always will be. Anyways, I keep ranting, but I truly believe that these long rants and explanations will help other traders connect the dots between theory and real-time execution in their own trading. Trading is a process and it develops over time. So you can watch a quick microwave video on a setup, but you truly learn spending hours reading the tape and watching candles form. That helps when someone is analyzing the charts, interpreting price in real time, explaining their thought processes, sharing context, nuances, mindset, and reasoning. It helps you internalize patterns and psychological responses in trading that can either help you or hurt you. And like I said, this is not something that you can just take a short course and internalize it. It comes with studying price, reading the tape, repetition of your executions, and journaling over a long period of time and different set samples of trades. Well, multiple set samples of the same trades. But the process is so brutal, and most people don't stay in the game long enough to see progress. So even though I'm talking a lot, I think anyone who's serious about learning will appreciate the discussion because I'm here to provide value the same way ICT did for me. Anyways, let's finally dive into the final discussion. The model is basically any reason to go long or short, targeting the midpoint of the opening range gap and using the size of the gap to gauge the probability of a midpoint gap fill. And the larger the gap, the less likely it is to fill to the midpoint. And there's a lot more underlying context that I'm not mentioning here to keep it brief. And I can't teach the same way ICT does in his lectures, but with each video and trade breakdown, I will sprinkle in more things about how I trade around these ideas. And it will start to connect some dots the more you see how it works. But ICT actually designed this for his son to give him structure. So he told him to use the first presented fair value gap as an entry mechanism and target the midpoint of the opening range gap and use that as your initial draw on liquidity within the first 30 minutes. So from 9:30 to 10 a.m. And for him, for his structure, if that time period is already over, then he doesn't trade. And that's just what it is. That's just part of the rules that he created for his son. He also mentions that us as his students are not restricted to just this. This is just for his son. So if we see a different fair value gap or a different entry that makes sense to us, we have the freedom to do that. And that's our risk to take. And the more I talk about trade breakdowns, I will show you what I mean about this and how we can be creative with our entries and how I study price in regards to the opening range gap. But the structure the model gives me is a specific time to trade after 9:30 a.m. Eastern Standard Time. I mark and study the same things every day, then I review how market conditions and my daily bias differ in relation to the size and how price engages with the opening range gap. I'll mark out the opening range gap, liquidity levels, and any fair value gaps that stand out, and I'll see when or if price retraces back into the opening range gap, and if so, how much it retraces into it. Overall, the mentorship was where I started with ICT's content, and I still continue to study his stuff. But this mentorship in particular helped me massively. It taught me how to read the tape. Basically, reading the tape is seeing where price is on the chart and where it's likely to draw to next, and how to use fair value gaps. He teaches his particular way of how to use fair value gaps. And just hearing the psychology lessons from his 30 plus years of experience helped me a lot. And it's not for everyone, but it definitely helped me in my journey. So after that long discussion, I will pull up screenshots of the trade execution that got me this last payout on August 21st of $3,300. So give me a moment to change from the browser to my notes. In the last video, I saw that my screen wasn't fully cropped when I pulled up the screenshots. So this time I'm going to check and make sure that the screen is fully cropped in this set of screenshots. So bear with me, give me a moment. I'm pulling it up because I have to toggle in between screens on OBS. There we go. I have the screen up. Now let's make sure that it is centered, cropped correctly. Okay. So what we're looking at is these two blue lines, right? These are the borders of the opening range gap. And what I do is after 9:30 a.m. Eastern time, which is 6:30 a.m. Pacific time for me, I mark out the high border, the top border, and the bottom border of the opening range gap. And the top border of the opening range gap is the closing price of regular trading hours from the previous day, and the opening price is the bottom border. The opening price of regular trading session is the bottom border. So this gap is basically the regular trading hour session gap. So we closed at this price yesterday and we open at this price today. And the 6:30 a.m. candle is when this bottom border forms. So what I do is I mark out the top and bottom border, and then I draw any prominent buy side or sell side liquidity levels. And you can't see them here because this is such a small time frame. But the higher time frame liquidity levels are my draw on liquidity, and I use those to kind of see where price is likely to draw to. But here, ICT actually says, and let's just be clear, this is how I interpreted the mentorship, and this is how I use it. So if you truly want to learn, you have to go to his mentorship videos. But he mentioned that within the first 30 minutes, if the gap is larger, it's less likely to fill to the midpoint. But since this gap was really small, I think this measured about less than 100 ticks. I can't really see. I think it was about 60 to 70 ticks. Less than 100 ticks. So this was a relatively small gap. So within the first 30 minutes, it did fill to the midpoint of the opening range gap. So once that's over, the model is actually over. But what I do when I study price in regards to the opening range gap, I see how it continues to engage with it later in the session. So since the model was over, I kind of just watched price and see how price engaged with the top order, and it just kind of stayed within it. And then when PMI news hit, price just dumped, right? And that's where I took a reversal. And I didn't anticipate like a huge dump because since the opening range gap measured so small, like there wasn't a huge gap. Small gaps are usually, they're not all the time, but usually what I noticed, and this is something you'll have to study yourself, small gaps are usually like with range days. So if there's a small gap, you'll typically see like a ranging type of day. Large gaps are usually like trending days, if that makes sense. But this is just something you'll have to study. So since I didn't anticipate like some huge, like drastic dump that goes on forever, what I did was I took this reversal and this candle formed, and I actually went in with high leverage. And this is dangerous because when you have $1,500 in drawdown for the 25K accounts, you can blow your account really fast. So I took the reversal with 2 contracts. My target was 50 ticks. And it was scary just seeing price kind of go lower because it makes you think that price is going to dump. But I just trusted that price was going to re-engage with the bottom border of the opening range gap. Just because when I tape read, I just see price engage with the opening range gap a lot. And this is something that comes with intuition. And intuition in trading is something that you can't really explain, but your brain kind of processes it in the background. And it's like, you kind of like have this intuition that something's going to happen, but you can't really explain it, if that makes sense. So I took a reversal. I had my stop below this low, but also that's dangerous because risking a lot. Too many contracts is you're basically risking a whole big portion of the $1,500 buffer. So that's dangerous, but I still went for it. And it just is what it is. This is just how I trade. And I noticed with gold, the 30-second fair value gaps in regards to this model make more sense because ICT, he uses the 1 minute time frame to look at fair value gaps for this model. And they do look better with NQ. But I noticed gold makes really nice 30-second fair value gaps. But just remember, whatever's happening on the 30-second chart is happening on the 1 minute chart. So here is the 1 minute chart that's zoomed out, but the reversal happened here, and it never went past this low. So when I take reversals, I like to have a stop below the low, because if you really think about it, if price reverses, price shouldn't go past that low. But still, this is a big portion of the buffer that you have. And 2 contracts is a lot, which is why it was scary holding for this, but I just kind of like trusted the setup for 50 ticks and see how I targeted below the opening range gap. I didn't want to hold just for a couple of ticks, just to milk it for a couple of ticks, just to risk it reversing, because this is a huge fair value gap. What if it just retraced back into this fair value gap and respected it? But it didn't. And price re-engaged with the bottom border of the opening range gap. And 50 ticks with 2 mini contracts is $1,000, and I copy traded this across 4 accounts. And that's how I got the 3.3K payout across 4 accounts, because 4,000 times 0.8, which calculates your profit split that you keep, is 3.3K. But anyways, I want to end it here. If you have any other topics you want to discuss or questions, please leave them down in the comments below, and I will put them in my list of topics. But for now, take care, peace out, be safe, and good luck out there.